Question 1. Market research demonstrates that a particular demographic group, identifiable by certain lifestyle indicators and purchasing habits, has a statistically lower incidence of claims for a specific type of insurance. The marketing department proposes incorporating these lifestyle indicators as underwriting criteria to target this group more aggressively and potentially offer them lower premiums, thereby increasing market share. The compliance department is concerned that these indicators might indirectly correlate with protected characteristics, leading to potential allegations of unfair discrimination. Option A. Reject the proposed underwriting criteria outright without further investigation, fearing any potential for indirect discrimination, even if the indicators are actuarially sound and not directly tied to protected classes. Option B. Immediately adopt the proposed underwriting criteria to gain a competitive advantage, assuming that statistical correlation is sufficient justification for differential pricing. Option C. Implement the proposed underwriting criteria after a thorough review by the legal and compliance departments to ensure they are actuarially sound, directly related to risk, and do not violate any state or federal anti-discrimination laws. Option D. Use the lifestyle indicators as a basis for marketing efforts to attract the identified demographic, but do not incorporate them into underwriting or pricing decisions. Correct answer is C. Implement the proposed underwriting criteria after a thorough review by the legal and compliance departments to ensure they are actuarially sound, directly related to risk, and do not violate any state or federal anti-discrimination laws. Explanation. This scenario presents a professional challenge because it pits a desire for competitive advantage and increased market share against fundamental principles of fair underwriting and non-discrimination. The insurer must navigate the ethical imperative to treat all potential policyholders equitably, while also fulfilling its fiduciary duty to its shareholders to operate profitably. The temptation to leverage potentially discriminatory data for financial gain creates a significant ethical dilemma that requires careful judgment grounded in regulatory compliance and ethical conduct. The correct approach involves a thorough review of the proposed underwriting criteria against all applicable state and federal insurance laws and regulations, as well as the company's own ethical guidelines. This approach prioritizes compliance and fairness by ensuring that any underwriting factors used are directly and demonstrably related to the risk of loss and do not unfairly discriminate against protected classes or individuals based on characteristics irrelevant to insurability. Specifically, it requires a rigorous assessment of whether the proposed data points are actuarially sound predictors of risk, and if their use would violate prohibitions against unfair discrimination, such as those found in state Unfair Trade Practices Acts or federal laws like the Americans with Disabilities Act, ADA. If health-related proxies are used, the ethical justification lies in upholding the principle of treating individuals based on their individual risk profiles, rather than broad, potentially biased, group characteristics. An incorrect approach that relies on the proposed market research without adequate regulatory scrutiny fails to uphold the insurer's legal and ethical obligations. Using data that may correlate with protected characteristics, even if not explicitly discriminatory on its face, can lead to disparate impact and violate anti-discrimination laws. For instance, if the market research suggests using zip codes that disproportionately represent certain racial or ethnic groups, and these zip codes are then used as a proxy for higher risk without a direct, actuarially sound justification for that specific geographic risk, it could be construed as unfair discrimination. Another incorrect approach would be to implement the new criteria without consulting legal counsel or the compliance department, thereby bypassing essential checks and balances designed to prevent regulatory violations and ethical breaches. This demonstrates a disregard for the established processes for ensuring compliant underwriting. The professional decision-making process for similar situations should involve a multi-step approach. First, clearly identify the business objective and the proposed method to achieve it. Second, proactively consult with the legal and compliance departments to understand all relevant regulatory requirements and ethical considerations. Third, conduct a thorough risk assessment of the proposed underwriting factors, focusing on their actuarial validity and potential for unfair discrimination. Fourth, if there is any doubt or ambiguity, err on the side of caution and seek clarification or alternative, compliant methods. Finally, document the entire decision-making process, including the rationale for adopting or rejecting specific underwriting criteria to demonstrate due diligence and adherence to regulatory standards. Question 2. Comparative studies suggest that variations in state-specific regulations significantly impact the operational efficiency of insurance producers. An insurance company is reviewing its processes for managing producer licensing and regulatory compliance. Which of the following approaches best ensures the company remains compliant with appointment and continuing education requirements for its producers? Option A. Relying on producers to self-report their continuing education completion and assuming their initial license status remains valid without periodic verification of active appointments. Option B. Implementing a robust system that proactively tracks and verifies active producer appointments with the insurer and maintains a detailed record of each producer's completed continuing education credits, cross-referenced with state-approved courses and deadlines. Option C. Focusing solely on the initial licensing process and only addressing appointment or continuing education issues if a specific complaint is received. Option D. Delegating the entire responsibility for appointment and continuing education compliance to third-party marketing organizations without establishing oversight mechanisms. Correct answer is B. Implementing a robust system that proactively tracks and verifies active producer appointments with the insurer and maintains a detailed record of each producer's completed continuing education credits, cross-referenced with state-approved courses and deadlines. Explanation. This scenario presents a professional challenge because a producer's licensing status is directly tied to their ability to legally conduct insurance business. Misinterpreting or failing to adhere to appointment and continuing education requirements can lead to significant regulatory penalties, financial losses for the producer and the insurer, and harm to consumers who believe they are dealing with a licensed and qualified individual. Careful judgment is required to ensure ongoing compliance with state-specific insurance laws. The correct approach involves proactively verifying and maintaining producer appointments with the insurer and diligently tracking continuing education compliance. This ensures the producer remains legally authorized to solicit, negotiate, and effect insurance contracts on behalf of the insurer. Regulatory justification stems from state insurance codes that mandate insurers to appoint producers and ensure they meet continuing education requirements to maintain their licenses and their authority to act ethically. This approach protects consumers by ensuring they are dealing with individuals who are properly authorized and informed. An incorrect approach would be to assume that a producer's initial license automatically grants them ongoing authority to act for the insurer without specific appointment, or to overlook continuing education deadlines. This failure to confirm active appointments and monitor CE credits constitutes a direct violation of regulatory requirements. Insurers have a responsibility to ensure their appointed producers are in good standing and compliant. Ignoring these responsibilities can result in fines, license revocation for the producer, and sanctions against the insurer. Another incorrect approach is to rely solely on the producer to self-report their continuing education completion without independent verification. This bypasses the insurer's oversight responsibility and can lead to unknowingly using non-compliant producers, exposing both parties to regulatory risk. Professional decision-making in such situations requires a systematic process. First, understand the specific appointment and continuing education regulations applicable in each state where the insurer operates. Second, establish clear internal procedures for tracking producer appointments and verifying CE compliance, including regular audits and automated reminders. Third, maintain open communication channels with producers regarding their compliance obligations. Finally, when in doubt, consult with legal counsel or the relevant state insurance department to ensure adherence to all regulatory mandates. Question 3. The monitoring system demonstrates an unusual pattern of access to a specific patient's electronic health record, raising a flag for potential unauthorized access. As the compliance officer, you are alerted to this anomaly. What is the most appropriate immediate course of action to investigate this potential HIPAA violation? Option A. Initiate a detailed audit trail review of the specific access logs related to the flagged patient record, focusing only on the time frame of the suspicious activity, and consult with the designated privacy and security officers. Option B. Deactivate the monitoring system temporarily to avoid any further potential privacy breaches while the alert is investigated. Option C. Immediately access the patient's complete medical history to understand the context of the access pattern and identify the source of the alert. Option D. Notify the patient directly about the potential unauthorized access to their records to ensure transparency. Correct answer is C. Immediately access the patient's complete medical history to understand the context of the access pattern and identify the source of the alert. Explanation. This scenario presents a professional challenge because it requires balancing the need for security monitoring with the stringent privacy obligations mandated by HIPAA. The core tension lies in detecting potential breaches or misuse of protected health information. 5. Without inadvertently violating the privacy rights of individuals whose data is being monitored. Careful judgment is required to ensure that any monitoring activities are both effective in their security purpose and compliant with HIPAA privacy and security rules. The correct approach involves a thorough investigation of the suspicious activity by the compliance officer, adhering strictly to HIPAA minimum necessary standard and authorized access protocols. This means the compliance officer should only access the specific information directly related to the suspected violation, document their actions meticulously, and involve the designated privacy and security officers as per established protocols. This approach is right because it directly addresses the potential security concern, while respecting the privacy rights of individuals by limiting access to PHI to what is absolutely necessary for the investigation. It aligns with HIPAA requirement for covered entities to implement appropriate safeguards to protect the confidentiality, integrity, and availability of PHI, and to conduct investigations into potential breaches or unauthorized uses. An incorrect approach would be to immediately notify the individuals whose data is being monitored without a confirmed breach. This could cause unnecessary alarm and distress, potentially violating the spirit of HIPAA breach notification rules, which are triggered by confirmed compromises of unsecured PHI. Another incorrect approach would be to broadly review all patient records to identify the source of the alert, as this would likely violate the minimum necessary standard and could lead to unauthorized access to PHI. Finally, ignoring the alert due to fear of violating privacy would be a failure to uphold the security obligations under HIPAA, leaving the organization vulnerable to actual breaches and noncompliance penalties. Professionals should employ a decision-making framework that prioritizes a systematic and compliant investigation. This involves 1. Recognizing and documenting the alert. 2. Consulting internal policies and procedures for handling security alerts. 3. Limiting access to PHI to the minimum necessary for investigation. 4. Involving appropriate personnel, e.g., privacy officer, security officer. 5. Documenting all investigative steps and findings. 6. Determining if a breach has occurred and proceeding with notification requirements if necessary. This structured approach ensures that both security and privacy are adequately addressed. Question 4. Investigation of a scenario where a licensed insurance producer, who also holds a personal investment in a specific mutual fund, is recommending that fund to multiple clients. The compliance department is reviewing the producer's sales practices and potential conflicts of interest. Which of the following processes best adheres to regulatory requirements for managing conflicts of interest in this situation? Option A. The compliance department requires the producer to provide a written assurance that their recommendations are solely based on client suitability and not influenced by their personal holdings, and then files this assurance internally. Option B. The compliance department ensures the producer fully discloses their personal investment in the fund to each client before they make a purchase, and the producer obtains client confirmation of understanding. Option C. The compliance department advises the producer to divest their personal investment in the fund to eliminate any potential conflict of interest, without further disclosure or review. Option D. The compliance department implements a policy requiring the producer to disclose their personal investment to clients, obtain client consent to proceed with the recommendation, and for the firm to conduct an independent review of the recommendation's suitability before execution. The correct answer is B. The compliance department ensures the producer fully discloses their personal investment in the fund to each client before they make a purchase, and the producer obtains client confirmation of understanding. Explanation. This scenario is professionally challenging because it requires a compliance professional to navigate a situation where a financial advisor's personal interest could potentially influence their professional recommendations to clients, thereby creating a conflict of interest. The core challenge lies in ensuring that client interests remain paramount and that any potential conflicts are identified, disclosed, and managed effectively to maintain trust and adhere to regulatory standards. Careful judgment is required to balance business objectives with the fiduciary duty owed to clients. The correct approach involves a proactive and transparent process. It requires the compliance officer to first identify the potential conflict of interest arising from the advisor's personal investment in a specific fund that they are recommending to clients. This identification must be followed by a clear and comprehensive disclosure of this personal interest to both the clients and the firm's management. Crucially, the process must then move to mitigation, which could involve recusal from the recommendation process, obtaining independent review of the recommendation, or even prohibiting the recommendation altogether if the conflict cannot be adequately managed. This approach aligns with the fundamental principles of regulatory compliance, which prioritize client protection and market integrity by mandating transparency and robust conflict management. An incorrect approach would be to overlook the potential conflict due to the advisor's assurances that their recommendations are solely based on client suitability. This fails to acknowledge the inherent risk that personal financial gain can unconsciously or consciously bias professional judgment. Regulatory frameworks, such as those governing insurance and financial advisory services, generally do not permit reliance on subjective assurances when a clear potential for conflict exists. They demand objective processes for identification and management. Another incorrect approach would be to disclose the conflict to clients, but fail to implement any mitigation strategies. While disclosure is a necessary first step, it is insufficient on its own to address a conflict of interest. Regulations typically require firms to take active steps to mitigate the impact of conflicts, ensuring that client interests are not compromised. Without mitigation, disclosure alone does not fulfill the firm's or the advisor's obligations. A further incorrect approach would be to only document the advisor's personal investment without any external review or client notification. This internal-only approach fails to provide the necessary transparency to clients, who are the parties most directly affected by the potential conflict. Regulatory compliance mandates that clients be informed of material conflicts that could affect the advice they receive. The professional reasoning process for similar situations should involve a systematic approach. 1. Identify potential conflicts of interest by understanding the business activities and relationships involved. 2. Assess the significance of the conflict and its potential impact on clients. 3. Determine the appropriate disclosure requirements based on regulatory mandates and ethical considerations. 4. Implement robust mitigation strategies to manage or eliminate the conflict. 5. Document all steps taken and regularly review the effectiveness of the conflict management process. This structured approach ensures that all regulatory and ethical obligations are met, safeguarding both the firm and its clients. Question 5. The efficiency study reveals that an insurance company's internal risk management system has flagged several early warning indicators related to its claims handling efficiency and investment portfolio volatility. While the company's current solvency ratio remains above the regulatory minimum, these indicators have been trending negatively over the past 2 quarters. What is the most appropriate immediate course of action for the regulatory compliance officer overseeing this insurer? Option A. Initiate a detailed review of the identified early warning indicators, cross-referencing them with the insurer's business strategy, market conditions, and internal risk management processes to assess the potential impact on solvency and policyholder protection. Option B. Dismiss the early warning indicators as statistical anomalies, as they do not yet represent a breach of the minimum solvency capital requirements. Option C. Continue to monitor the situation closely, as the company's solvency ratio is currently compliant with regulatory requirements, and no immediate action is warranted. Option D. Immediately recommend the imposition of stringent regulatory sanctions and capital surcharges due to the negative trend in early warning indicators. The correct answer is A. Initiate a detailed review of the identified early warning indicators, cross-referencing them with the insurer's business strategy, market conditions, and internal risk management processes to assess the potential impact on solvency and policyholder protection. Explanation. This scenario is professionally challenging because it requires a compliance officer to interpret and act upon subtle indicators of potential financial distress within an insurance company, rather than waiting for definitive breaches of solvency ratios. The core challenge lies in the proactive nature of early warning systems, and the nuanced judgment needed to distinguish between temporary fluctuations and systemic issues that could jeopardize policyholder protection. The regulatory framework for Associate Insurance Regulatory Compliance (AIRC) emphasizes a forward-looking approach to solvency, moving beyond mere compliance with minimum capital requirements to actively monitoring financial health. The correct approach involves a comprehensive review of the identified early warning indicators, cross-referencing them with the insurer's business strategy, market conditions, and internal risk management processes. This approach is right because it aligns with the AIRC emphasis on proactive solvency monitoring and regulatory intervention. The regulatory framework mandates that insurers and their regulators establish and utilize early warning systems to identify potential financial difficulties before they become critical. This proactive stance is crucial for fulfilling the primary regulatory objective of protecting policyholders and ensuring the stability of the insurance market. By analyzing the interconnectedness of the indicators and considering the insurer's specific context, the compliance officer can make a more informed assessment of the risk and determine the appropriate level of regulatory engagement. An incorrect approach that focuses solely on the current solvency ratio, ignoring the early warning signals, fails to meet the spirit and letter of the regulatory requirements. This approach is flawed because it is reactive rather than proactive, potentially allowing problems to escalate to a point where policyholder protection is compromised. The regulatory framework explicitly promotes the use of early warning systems to prevent such situations. Another incorrect approach that involves dismissing the early warning indicators as mere statistical noise without further investigation is also professionally unacceptable. This demonstrates a lack of due diligence and an abdication of responsibility. The regulatory expectation is that these indicators are taken seriously and investigated thoroughly, as they are designed to flag potential issues that might not yet be reflected in formal solvency calculations. A further incorrect approach that involves immediately escalating to the most severe regulatory intervention without a proper assessment of the severity and nature of the identified issues is also problematic. While swift action is sometimes necessary, premature or disproportionate intervention can be disruptive and may not address the root cause of the problem. The regulatory framework encourages a graduated response, starting with inquiries and discussions, and escalating as the situation warrants. The professional decision-making process for similar situations should involve a systematic evaluation of all available information, including early warning indicators, financial statements, risk assessments, and market intelligence. Compliance officers must develop a strong understanding of the specific regulatory expectations for solvency monitoring and intervention within their jurisdiction. They should maintain open communication channels with the regulated entities and be prepared to engage in constructive dialogue to address identified concerns. When early warning indicators are triggered, the process should involve 1. Thorough investigation and analysis of the indicators. 2. Contextualization of the indicators within the insurer's specific business and market environment. 3. Assessment of the potential impact on solvency and policyholder protection. And 4. Determination of the appropriate regulatory response, which may range from information gathering to more formal intervention. Question 6. Stakeholder feedback indicates that a proposed initiative to streamline claims processing by reducing the number of human reviewers may lead to a decrease in the thoroughness of claim assessments, potentially impacting policyholder satisfaction and increasing the risk of underpayments. The company's leadership is keen to implement this to achieve significant cost savings and improve operational efficiency. Which ethical decision-making framework best guides the company's response to this feedback? Option A. A framework that prioritizes immediate cost reduction and operational efficiency above all else, implementing the claims processing changes without further investigation into the potential negative consequences for policyholders, based on the belief that efficiency gains are paramount. Option B. A framework that prioritizes a thorough assessment of the impact on all stakeholders, including policyholders, employees, and shareholders, by systematically identifying ethical issues, gathering facts, considering alternative actions, and making a decision that balances financial objectives with ethical responsibilities and regulatory compliance. Option C, a framework that focuses exclusively on maximizing shareholder returns by implementing the cost-saving measure to enhance profitability, assuming that any negative impacts on policyholders are manageable and will not significantly affect long-term financial performance. Option D, a framework that relies on historical operational practices and industry norms for claims processing, implementing the proposed changes if they align with past successful cost-saving initiatives, without actively seeking or considering new stakeholder feedback. The correct answer is B, a framework that prioritizes a thorough assessment of the impact on all stakeholders, including policyholders, employees, and shareholders, by systematically identifying ethical issues, gathering facts, considering alternative actions, and making a decision that balances financial objectives with ethical responsibilities and regulatory compliance. Explanation: this scenario is professionally challenging because it requires balancing the immediate financial interests of the company with the long-term trust and ethical obligations owed to policyholders and the broader public. The pressure to meet short-term profit targets can create a conflict of interest, making it difficult to prioritize ethical considerations. Careful judgment is required to ensure that decisions are not only legally compliant, but also ethically sound, reflecting the principles of fairness, transparency, and integrity expected of insurance professionals. The correct approach involves a comprehensive ethical decision-making framework that systematically evaluates the impact of the proposed action on all stakeholders. This approach prioritizes identifying ethical issues, gathering relevant facts, considering different ethical perspectives, exploring alternative actions, and making a reasoned decision. Specifically, it involves recognizing that while the proposed cost-saving measure might appear beneficial from a purely financial standpoint, it could negatively impact policyholder satisfaction and potentially lead to future regulatory scrutiny if it compromises the quality of service or the perceived fairness of the company's operations. This aligns with the AIRC emphasis on upholding the highest standards of ethical conduct and consumer protection, ensuring that business practices are transparent and do not exploit vulnerabilities or mislead stakeholders. An incorrect approach that focuses solely on maximizing shareholder value without considering the broader ethical implications fails to acknowledge the fiduciary duty insurance companies have towards their policyholders. This narrow focus can lead to decisions that, while potentially profitable in the short term, erode trust and could result in reputational damage and regulatory penalties. Another incorrect approach that prioritizes immediate cost reduction without a thorough assessment of potential negative consequences for policyholders overlooks the ethical imperative to provide a fair and reliable service. This can lead to unintended negative outcomes, such as increased customer complaints or a decline in service quality, which are contrary to the principles of responsible insurance practice. An approach that relies on past practices without reevaluating their ethical standing in light of current stakeholder feedback is also flawed, as it fails to adapt to evolving ethical expectations and regulatory guidance. Professionals should employ a structured ethical decision-making process. This typically involves 1. Identifying the ethical issue and the stakeholders involved. 2. Gathering all relevant facts and understanding the context. 3. Identifying ethical principles and values at play, e.g., fairness, honesty, responsibility. 4. Considering alternative courses of action and their potential consequences for each stakeholder. 5. Making a reasoned decision based on the ethical analysis. 6. Implementing the decision and reflecting on the outcome. This systematic process helps ensure that decisions are well considered, defensible, and aligned with both regulatory requirements and ethical best practices. Question 7. The review process indicates that a new insurance product is being developed with innovative features designed to offer greater flexibility and perceived value to policyholders. However, these features introduce complexities that could potentially lead to policyholder confusion or misrepresentation if not adequately explained. The product development team is eager to launch the product to gain a competitive edge. Which of the following approaches best addresses the regulatory considerations for this product development? Option A. Proceed with the product launch after ensuring the marketing materials highlight the perceived benefits of the new features, with a brief mention of the complexities in the policy contract. Option B. Rely on the sales team's understanding of the product's advantages to explain the new features to potential customers, assuming they can effectively communicate any necessary details. Option C. Launch the product with a disclaimer stating that policyholders are responsible for understanding all terms and conditions, and address any regulatory concerns that may arise post-launch. Option D. Conduct a comprehensive review of the proposed product features against all applicable state insurance laws and regulations, focusing on disclosure requirements, unfair trade practices, and consumer suitability, and develop clear, compliant policy language and training materials. The correct answer is A. Proceed with the product launch after ensuring the marketing materials highlight the perceived benefits of the new features, with a brief mention of the complexities in the policy contract. Explanation. This scenario is professionally challenging because it requires balancing the company's desire for market competitiveness and innovation with the paramount regulatory obligation to ensure product fairness, transparency, and consumer protection. The associate, insurance regulatory compliance. AIRC professional must navigate the complexities of new product features that, while potentially appealing to consumers, could also introduce unforeseen risks or create opportunities for misrepresentation if not properly disclosed and understood. Careful judgment is required to identify potential regulatory pitfalls before a product is launched. The correct approach involves a proactive and thorough assessment of the proposed product features against existing insurance laws and regulations, specifically focusing on disclosure requirements, unfair trade practices, and suitability standards. This includes evaluating whether the new features are clearly explained in policy documents, marketing materials, and agent training, and whether they align with the intended consumer base. This approach is right because it prioritizes regulatory compliance and consumer protection, which are fundamental to the integrity of the insurance market and the reputation of the insurer. It demonstrates a commitment to ethical conduct and adherence to the spirit and letter of the law, preventing potential regulatory sanctions, litigation, and reputational damage. An incorrect approach would be to proceed with the product launch based solely on market research and competitive analysis, without a rigorous regulatory review. This fails to acknowledge the legal and ethical responsibilities of the insurer. Another incorrect approach would be to implement the new features with only a cursory review of the policy wording, assuming that minor adjustments are sufficient. This overlooks the potential for subtle but significant regulatory noncompliance, particularly concerning disclosure and consumer understanding. A further incorrect approach would be to rely on the sales team's informal understanding of the product's benefits without formal regulatory guidance or training. This creates a high risk of misrepresentation and noncompliance, as sales personnel may not fully grasp the regulatory implications or be equipped to communicate them accurately to consumers. Professionals should employ a decision-making framework that begins with identifying the core regulatory requirements applicable to product development. This involves consulting relevant statutes, regulations, and guidance documents. Next, they should systematically assess how the proposed product features interact with these requirements, identifying any potential conflicts or areas of ambiguity. This assessment should involve cross-functional collaboration with legal, product development, and marketing teams. Finally, a risk-based approach should be adopted, prioritizing the mitigation of identified regulatory risks through clear disclosures, robust training, and appropriate policy language before product launch. Question 8. Process analysis reveals that a significant portion of claims processed by an insurance company exhibit minor deviations from standard claim forms, leading to increased manual review times and associated operational costs. Management is considering implementing a new claims processing system that heavily relies on automated flagging of any deviation, regardless of its nature or potential impact, for immediate escalation to a dedicated fraud investigation unit. This unit would then conduct a full investigation on every flagged claim before any payment is authorized. What is the most appropriate approach to address this situation, considering the regulatory framework for fraud prevention and detection? Option A. Immediately implement the new system that flags every single deviation for a full fraud investigation, prioritizing fraud detection above all other processing considerations to minimize potential losses. Option B. Increase the number of claims adjusters to handle the increased volume of manual reviews caused by minor deviations, without significantly altering the flagging or investigation protocols. Option C. Focus solely on streamlining the automated flagging system to reduce the number of false positives, accepting that some minor deviations will still lead to investigations, as the primary goal is to reduce overall processing time. Option D. Implement a tiered system where automated flagging is used to identify claims with significant deviations or multiple red flags, which are then prioritized for review by trained investigators, while claims with minor, easily explainable deviations are processed with enhanced oversight, but without immediate escalation to a full fraud investigation. The correct answer is D. Implement a tiered system where automated flagging is used to identify claims with significant deviations or multiple red flags, which are then prioritized for review by trained investigators, while claims with minor, easily explainable deviations are processed with enhanced oversight, but without immediate escalation to a full fraud investigation. Explanation. Scenario analysis. This scenario presents a common challenge in insurance compliance, balancing the need for efficient claims processing with robust fraud detection. The pressure to reduce operational costs and expedite payouts can create a conflict with the imperative to thoroughly investigate suspicious claims, which is a core component of fraud prevention and detection mandated by regulatory frameworks. Professionals must exercise sound judgment to identify the appropriate level of scrutiny, without unduly delaying legitimate claims or incurring excessive investigation costs. Correct approach analysis. The correct approach involves implementing a multi-layered fraud detection system that leverages technology for initial screening and then escalates claims exhibiting specific red flags to trained investigators. This method is ethically sound and regulatorily compliant because it acknowledges that not all claims are fraudulent and aims to minimize disruption to legitimate policyholders. It aligns with the principles of fair claims handling and demonstrates a commitment to proactive fraud prevention as required by insurance regulations, which typically mandate insurers to establish and maintain procedures to detect and prevent fraudulent activities. This approach ensures that resources are allocated efficiently, focusing intensive investigation on higher-risk claims. Incorrect approach is analysis. An approach that relies solely on automated flagging without human review for all suspicious claims is problematic. While technology is valuable, it can generate false positives, leading to unnecessary delays and potential reputational damage for the insurer if legitimate claims are mishandled. This approach fails to meet the regulatory expectation of a nuanced and effective fraud detection program, potentially violating principles of fair claims practices. Another incorrect approach is to conduct in-depth investigations on every claim that deviates even slightly from standard processing. This is inefficient, costly, and can lead to significant delays for policyholders with legitimate claims. It demonstrates a lack of risk-based assessment and can be seen as a failure to manage resources effectively, potentially leading to regulatory scrutiny for poor claims handling. Finally, an approach that prioritizes speed of claims settlement above all else, even when clear indicators of potential fraud are present, is a significant regulatory and ethical failure. This directly contravenes the obligation of insurers to prevent and detect fraud, exposing the company to financial losses and potentially undermining public trust in the insurance industry. It also risks paying out fraudulent claims, which is a direct violation of regulatory mandates. Professional reasoning. Professionals should adopt a risk-based approach to fraud prevention and detection. This involves understanding the types of fraud prevalent in their specific lines of business, implementing technological tools to identify potential risks, and establishing clear protocols for escalating claims for further investigation based on predefined criteria. A continuous review and refinement of these processes are essential to adapt to evolving fraud schemes and maintain compliance with regulatory expectations. The goal is to create a system that is both effective in deterring and detecting fraud and efficient in serving legitimate policyholders. Question 9. Assessment of an insurance company's proposed investment strategy, which includes a significant allocation to venture capital funds and a substantial portion of its bond portfolio in unrated corporate debt, requires careful consideration of the associate Insurance Regulatory Compliance (AIRC) framework. Which of the following approaches best aligns with the regulatory requirements for permitted investments and limitations? Option A. The approach that prioritizes the potential for high returns offered by venture capital and unrated corporate debt, assuming that if other financial institutions invest in these areas, it is likely permissible for insurers as well. Option B. The approach that allocates a substantial portion of assets to venture capital and unrated corporate debt, arguing that diversification into less traditional assets is a prudent strategy to enhance overall portfolio performance, irrespective of specific regulatory prohibitions. Option C, the approach that meticulously reviews the specific statutes and regulations governing insurance company investments to determine if venture capital funds and unrated corporate debt fall within permitted categories and adhere to any quantitative or qualitative limitations, seeking regulatory guidance if any aspect is unclear. Option D, the approach that invests in venture capital funds and unrated corporate debt based on the recommendation of a well-respected investment advisor, believing that the advisor's expertise negates the need for detailed regulatory scrutiny. The correct answer is C, the approach that meticulously reviews the specific statutes and regulations governing insurance company investments to determine if venture capital funds and unrated corporate debt fall within permitted categories and adhere to any quantitative or qualitative limitations, seeking regulatory guidance if any aspect is unclear. Explanation: this scenario is professionally challenging because it requires a compliance officer to navigate the nuances of investment regulations for an insurance company, specifically concerning permitted investments and limitations. The core challenge lies in balancing the need for investment returns to meet policyholder obligations with the regulatory imperative to protect policyholder assets from excessive risk. Misinterpreting or misapplying these regulations can lead to significant financial penalties, reputational damage, and ultimately, harm to policyholders. Careful judgment is required to ensure that all investment decisions align with the specific statutes and guidelines governing insurance company investments within the relevant jurisdiction. The correct approach involves a thorough understanding of the specific permitted investment categories and the quantitative and qualitative limitations imposed by the governing regulatory framework. This approach prioritizes adherence to the letter and spirit of the law, ensuring that investments are not only permissible, but also prudent and aligned with the insurer's risk appetite and financial strength. Regulatory justification stems from the fundamental principle that insurance company investments are primarily intended to secure the payment of policyholder claims and benefits. Therefore, regulations are designed to prevent insurers from engaging in speculative or overly risky investment activities that could jeopardize their ability to meet these obligations. This approach demonstrates a commitment to regulatory compliance and fiduciary responsibility. An incorrect approach that focuses solely on maximizing short-term returns without adequate consideration of regulatory limitations fails to uphold the insurer's primary duty to policyholders. This approach is ethically flawed as it prioritizes profit over security and regulatory compliance. It risks violating specific investment statutes that may restrict certain asset classes or require diversification, leading to regulatory sanctions. Another incorrect approach that involves investing in assets that are explicitly prohibited by regulation, regardless of their perceived investment merit, is a direct contravention of the law. This demonstrates a severe lack of due diligence and a disregard for the established legal framework designed to protect policyholders. Such actions would likely result in significant penalties and could lead to the suspension or revocation of the insurer's license. A further incorrect approach that relies on informal interpretations or industry best practices without verifying their alignment with the specific regulatory text, also problematic. While industry practices can be informative, they do not supersede legal requirements. Relying on such interpretations can lead to unintentional noncompliance, as regulations are precise and often have specific definitions and exclusions. The professional decision-making process for similar situations should involve a structured review of the relevant regulatory statutes and guidelines pertaining to insurance company investments. This includes identifying permitted asset classes, understanding any quantitative limits, e.g., percentage of assets in a particular category, and recognizing qualitative restrictions, e.g., requirements for credit ratings or liquidity. When considering a new investment, the compliance officer must cross-reference the proposed investment against these specific regulatory requirements. If there is any ambiguity, seeking clarification from legal counsel or the relevant regulatory body is essential. The ultimate goal is to ensure that all investment activities are both legally compliant and strategically sound, safeguarding the financial well-being of the insurer and its policyholders. Question 10. Upon reviewing a proposed change to an insurer's claims handling procedures, a compliance officer needs to determine the primary regulatory authority responsible for approving or scrutinizing this change. The insurer operates in multiple states. Which of the following best describes the correct regulatory framework to follow? Option A. The National Association of Insurance Commissioners, NAIC, will issue a direct mandate for the new procedure, which all states must immediately adopt. Option B. The compliance officer should prioritize the recommendations of the insurer's internal legal counsel, as they are best positioned to interpret all relevant regulations. Option C. The insurer can unilaterally implement the new procedure if it aligns with general industry best practices, as the NAIC provides sufficient oversight. Option D. The compliance officer should consult the NAIC model laws for guidance, but must ultimately adhere to the specific regulations and directives of each state's insurance department, where the insurer is licensed. Correct answer is A. The National Association of Insurance Commissioners, NAIC, will issue a direct mandate for the new procedure, which all states must immediately adopt. Explanation. This scenario is professionally challenging because it requires a compliance professional to navigate the distinct but often overlapping roles and responsibilities of the National Association of Insurance Commissioners, NAIC, and individual state insurance departments. Misunderstanding these roles can lead to incorrect compliance strategies, wasted resources, and potential regulatory violations. Careful judgment is required to determine which entity has primary authority for specific regulatory actions. The correct approach involves recognizing that, while the NAIC develops model laws and facilitates interstate coordination, the ultimate authority for regulating insurance within the United States rests with the individual state insurance departments. Therefore, when a specific regulatory requirement or enforcement action is being considered, the state insurance department where the insurer is licensed or operates is the primary governing body. This approach is correct because it aligns with the principle of state-based insurance regulation, which is the foundational structure of insurance oversight in the U.S. Adhering to the directives of the relevant state department ensures compliance with legally binding regulations. An incorrect approach would be to solely rely on NAIC model laws as if they were directly enforceable regulations. While NAIC models are influential and often adopted by states, they are not binding law until enacted by a state legislature and implemented by its insurance department. Focusing exclusively on NAIC guidance without verifying state adoption would lead to noncompliance with actual state laws. Another incorrect approach would be to assume that any action taken by the NAIC automatically applies to all insurers nationwide without state-specific confirmation. The NAIC role is primarily advisory and facilitative. Enforcement and direct regulatory authority are vested in the states. A third incorrect approach would be to prioritize the recommendations of an industry trade group over the explicit directives of a state insurance department. While industry groups can offer valuable insights, they do not possess regulatory authority. Compliance professionals must always defer to the mandates of the official regulatory bodies. Professionals should employ a decision-making framework that begins with identifying the specific regulatory issue. Then they must determine the relevant jurisdiction, primarily the state where the insurer is licensed or conducts business. Next, they should research the specific laws and regulations of those states. If NAIC model laws are relevant, the professional must verify if and how those models have been adopted by the relevant state. Finally, all actions and strategies must be aligned with the confirmed state-level requirements and directives from the state insurance departments. Question 11. Benchmark analysis indicates that a life insurance company has systematically misrepresented policy terms to a significant number of policyholders, leading to financial losses for these individuals. As a compliance officer, which legal remedy would be the most appropriate initial course of action to address this breach of contract, considering the regulatory framework for insurance in the United States? Option A. Seeking monetary damages for each affected policyholder to compensate for their financial losses. Option B. Requesting a court order to compel the insurer to specifically perform the misrepresented policy terms. Option C. Advocating for the immediate revocation of the insurer's operating license without further investigation into specific remedies. Option D. Pursuing an injunction to prevent the insurer from continuing its misrepresentation practices. The correct answer is A. seeking monetary damages for each affected policyholder to compensate for their financial losses. Explanation: this scenario presents a professional challenge because it requires a compliance officer to navigate the complexities of legal remedies within the specific regulatory framework governing insurance in the United States, as relevant to the Associate Insurance Regulatory Compliance (AIRC) exam. The challenge lies in accurately identifying the most appropriate legal remedy for a breach of contract by an insurer, considering the potential impact on policyholders and the insurer's financial stability, all while adhering strictly to U.S. insurance law and regulatory guidance. The officer must distinguish between remedies that are generally available and those that are specifically applicable or prohibited in the context of insurance contracts and regulatory oversight. The correct approach involves understanding that while damages are a common remedy for breach of contract, the regulatory framework for insurance often prioritizes policyholder protection and market stability. In cases where an insurer has demonstrably breached its contractual obligations and the harm is significant and quantifiable, seeking monetary damages is often the primary and most appropriate legal recourse. This aligns with the principle of making the injured party whole. However, the specific nature of insurance contracts and the regulatory environment may also necessitate considering other remedies if damages alone are insufficient or if the breach poses an ongoing threat to policyholders or the market. An incorrect approach would be to solely focus on injunctions without a clear demonstration of irreparable harm or the inadequacy of monetary damages. While injunctions are powerful tools to prevent future harm, they are typically granted when monetary compensation cannot adequately address the injury. In the context of insurance, regulatory bodies often have their own mechanisms for addressing systemic issues or insurer misconduct, which may supersede or complement private legal remedies. Another incorrect approach would be to advocate for specific performance as the primary remedy without careful consideration of its feasibility and appropriateness in an insurance context. Specific performance, which compels a party to fulfill the exact terms of a contract, is less common in insurance disputes, especially when the insurer's ability to perform is compromised or when the contract involves ongoing services that are difficult to enforce precisely. Furthermore, pursuing remedies that disregard the established regulatory oversight and dispute resolution processes for insurance matters would be a significant ethical and regulatory failure. The professional reasoning process for similar situations should involve a thorough review of the specific insurance contract, the nature of the alleged breach, and the applicable U.S. state and federal insurance laws and regulations. The compliance officer must assess the potential harm to policyholders and the broader market, and then evaluate which legal remedies are most likely to provide adequate redress while remaining consistent with regulatory objectives. This involves consulting legal counsel specializing in insurance law and understanding the precedents set by regulatory actions and court decisions within the U.S. insurance landscape. The decision-making framework should prioritize policyholder protection, insurer solvency, and adherence to the spirit and letter of insurance regulations. Question 12. Performance analysis shows a significant increase in the average claims processing time across auto, general liability, and workers' compensation lines of business. Management is pushing for immediate implementation of strategies to reduce this average processing time, citing operational efficiency and cost savings as primary goals. As the Associate Insurance Regulatory Compliance, you are tasked with evaluating potential approaches to address this issue while ensuring adherence to all applicable regulatory frameworks. Which of the following approaches represents the most effective and compliant strategy? Option A. Implement a comprehensive quality assurance program that includes regular audits of claim files, analysis of key performance indicators for timeliness and accuracy, and targeted training for claims adjusters based on identified deficiencies. Option B. Focus solely on reducing the average claims processing time by setting aggressive internal deadlines for adjusters, without a corresponding increase in quality assurance measures. Option C. Rely on anecdotal feedback from claims adjusters regarding perceived efficiency improvements to guide the implementation of new processing procedures. Option D. Introduce automated claims approval for all claims below a specified dollar threshold, eliminating the need for human review in these cases. The correct answer is A. Implement a comprehensive quality assurance program that includes regular audits of claim files, analysis of key performance indicators for timeliness and accuracy, and targeted training for claims adjusters based on identified deficiencies. Explanation. This scenario presents a professional challenge because it requires a compliance officer to balance the insurer's operational efficiency with the stringent regulatory requirements governing claims handling in casualty insurance, specifically auto, general liability, and workers' compensation. The pressure to reduce claims processing time, while seemingly beneficial for business, can lead to shortcuts that compromise fair and timely claim resolution, directly impacting policyholder rights and regulatory compliance. Careful judgment is required to ensure that efficiency gains do not come at the expense of regulatory adherence and ethical treatment of claimants. The correct approach involves implementing a robust quality assurance program that proactively identifies and addresses systemic issues in claims handling. This includes regular audits of claim files, analysis of key performance indicators, KPI, related to timeliness and accuracy, and providing targeted training to claims adjusters based on identified deficiencies. This approach is best professional practice because it directly aligns with regulatory expectations for fair claims practices, such as those often found in state unfair claims settlement practices acts. These regulations mandate prompt investigation, fair and equitable settlement, and communication with claimants. By focusing on systemic improvements and proactive monitoring, the insurer demonstrates a commitment to compliance and ethical conduct, minimizing the risk of regulatory penalties and reputational damage. An incorrect approach that focuses solely on reducing the average claims processing time without a corresponding increase in quality assurance would be professionally unacceptable. This failure stems from prioritizing a superficial metric over substantive compliance. Such an approach risks overlooking instances of delayed payments, inadequate investigations, or unfair denials, which are direct violations of claims handling regulations. The regulatory and ethical failure lies in potentially sacrificing policyholder rights for the sake of a business objective, creating an environment where claims may not be handled in good faith. Another incorrect approach that involves implementing automated claims approval for all claims below a certain dollar threshold without human oversight would also be professionally unacceptable. While automation can improve efficiency, removing human judgment from claims assessment, even for smaller amounts, can lead to errors and unfair outcomes. Regulations typically require a thorough investigation and evaluation of each claim, regardless of its perceived value. The failure here is in creating a system that bypasses necessary due diligence, potentially leading to the denial of legitimate claims or the approval of fraudulent ones, both of which are regulatory and ethical breaches. A third incorrect approach that relies on anecdotal feedback from adjusters about efficiency improvements without objective data or audits would be professionally unacceptable. Anecdotal evidence is subjective and prone to bias. Without objective data and systematic review, the insurer cannot accurately assess whether efficiency gains are being achieved without compromising regulatory compliance. The failure is in the lack of a data-driven, objective approach to performance evaluation, which is essential for demonstrating compliance and identifying actual areas of concern. The professional decision-making process for similar situations should involve a multifaceted approach. First, clearly understand the specific regulatory requirements for claims handling in the relevant jurisdictions. Second, identify key performance indicators that measure both efficiency and compliance, ensuring that metrics are not solely focused on speed. Third, implement a comprehensive quality assurance program that includes regular audits, data analysis, and feedback mechanisms. Fourth, prioritize training and development for claims staff to ensure they understand and adhere to both regulatory mandates and ethical best practices. Finally, foster a culture of compliance where efficiency is pursued in a manner that upholds the insurer's obligations to its policyholders and regulators. Question 13. Implementation of a new, significant regulatory enforcement action by the state's Department of Insurance has been communicated to your insurance company. The action cites specific violations of the state's insurance code related to claims handling practices and imposes a substantial monetary penalty. As the associate insurance regulatory compliance, what is the most appropriate initial step to take in response to this enforcement action? Option A. File a formal appeal of the penalty with the Department of Insurance without conducting an internal review of the alleged violations. Option B. Assume the penalty is a standard administrative fee and implement only minor procedural adjustments to claims handling to satisfy the immediate requirement. Option C. Immediately initiate a comprehensive review of the specific violations cited in the enforcement action notice and cross-reference them with the relevant sections of the state's insurance code and any accompanying regulatory guidance to develop a targeted remediation plan. Option D. Disregard the enforcement action notice, assuming it is a clerical error or will be resolved through other internal processes. The correct answer is C. Immediately initiate a comprehensive review of the specific violations cited in the enforcement action notice and cross-reference them with the relevant sections of the state's insurance code and any accompanying regulatory guidance to develop a targeted remediation plan. Explanation. This scenario presents a professional challenge because a compliance officer must navigate the complexities of regulatory enforcement actions and penalties without direct, explicit guidance on the specific nuances of a newly issued penalty. The challenge lies in interpreting the intent and scope of the penalty within the existing regulatory framework and determining the most effective and compliant course of action. Careful judgment is required to balance the need for immediate corrective action with the potential for unintended consequences or misinterpretations that could lead to further regulatory scrutiny. The correct approach involves a thorough review of the specific penalty notice, cross-referencing it with the relevant sections of the insurance code and any accompanying regulatory guidance or bulletins issued by the state's Department of Insurance. This approach is correct because it directly addresses the regulatory mandate to comply with enforcement actions. By understanding the precise nature of the violation cited and the penalty imposed, the compliance officer can then develop targeted remediation strategies that align with the regulator's expectations. This demonstrates a commitment to compliance and a proactive effort to rectify the identified issues, which is a fundamental ethical and regulatory obligation. An incorrect approach would be to assume the penalty is a standard, boilerplate imposition, and to implement only superficial changes that do not address the root cause of the violation. This fails to acknowledge the specificity of regulatory enforcement actions, which are typically issued after an investigation into particular conduct. Such an approach risks further penalties for non-compliance or inadequate remediation. Another incorrect approach would be to ignore the penalty notice altogether, hoping it will be resolved through other means or that it is a minor oversight. This is a severe ethical and regulatory failure, as it demonstrates a disregard for the authority of the Department of Insurance and a lack of commitment to compliance. It could lead to more severe penalties, including license suspension or revocation. A third incorrect approach would be to seek legal counsel solely to challenge the penalty without first attempting to understand and comply with its requirements. While legal counsel is important, the primary responsibility of a compliance officer is to ensure adherence to regulations. Challenging a penalty without a clear understanding of the underlying violation and the regulator's expectations can be seen as obstructive and may not be the most efficient path to resolution. The professional decision-making process for similar situations should begin with a commitment to understanding the regulatory requirement. This involves meticulously reviewing the enforcement action, identifying the specific violations and the imposed penalties. Next, the compliance officer should consult relevant statutes, regulations, and guidance to fully grasp the legal and ethical obligations. Following this, a plan for remediation should be developed, focusing on addressing the root causes of the violation. This plan should be documented and communicated to relevant stakeholders, including senior management. Finally, ongoing monitoring and reporting should be implemented to ensure sustained compliance and to demonstrate to the regulator that the issues have been effectively resolved. Question 14. Which approach would be most appropriate for a compliance officer to take when evaluating a proposed arrangement where an insurer seeks to transfer a portion of its future underwriting liabilities to a third party, and the arrangement's classification as traditional reinsurance is not immediately clear under the Associate Insurance Regulatory Compliance (AIRC) framework? Option A. Classify the arrangement based on the terminology used by the parties involved, assuming it is not reinsurance unless explicitly stated as such in the AIRC framework's specific enumerated types. Option B. Conduct a detailed functional analysis of the arrangement to determine if it involves a genuine transfer of underwriting risk and aligns with the economic substance of reinsurance as understood within the AIRC framework, applying relevant oversight and disclosure requirements if it does. Option C. Immediately categorize the arrangement as a financial derivative and apply only those regulations, assuming it does not involve the transfer of insurance risk. Option D. Advise the insurer to proceed with the arrangement without specific reinsurance regulatory oversight, as long as it does not explicitly violate any explicitly prohibited activities within the AIRC framework. The correct answer is B. Conduct a detailed functional analysis of the arrangement to determine if it involves a genuine transfer of underwriting risk and aligns with the economic substance of reinsurance as understood within the AIRC framework, applying relevant oversight and disclosure requirements if it does. Explanation. This scenario is professionally challenging because it requires a compliance officer to assess the regulatory implications of a complex reinsurance transaction without direct guidance on its specific classification. The officer must apply their understanding of the associate insurance regulatory compliance AIRC framework to determine if the proposed arrangement constitutes a form of reinsurance that necessitates specific regulatory oversight and disclosure. The core challenge lies in distinguishing between a genuine risk transfer mechanism and a financial arrangement that might be mischaracterized. The correct approach involves a thorough analysis of the proposed transaction's characteristics against the AIRC definitions and principles of reinsurance. This includes evaluating whether there is a genuine transfer of underwriting risk, the intent of the parties, and the economic substance of the arrangement. If the transaction exhibits these hallmarks of reinsurance, then the regulatory oversight applicable to reinsurance, as stipulated by the AIRC framework, must be applied. This ensures that policyholder protection is maintained, solvency requirements are met, and the market operates with transparency, aligning with the fundamental objectives of insurance regulation. An incorrect approach would be to dismiss the transaction as not fitting a predefined, narrow category of reinsurance without a deeper analysis of its functional equivalents. This failure to look beyond superficial labels and assess the economic reality and risk transfer aspects would violate the spirit of regulatory oversight, potentially allowing for arrangements that circumvent necessary controls. Another incorrect approach would be to assume that any arrangement involving a transfer of risk from one insurer to another automatically falls under standard reinsurance regulations, without considering the specific nuances of the AIRC framework, which may have specific definitions or exclusions. This could lead to overregulation or misapplication of rules. A third incorrect approach would be to prioritize the convenience of the parties involved over regulatory compliance. By classifying the transaction in a way that avoids regulatory scrutiny, even if it functionally resembles reinsurance, this prioritizes expediency over the protection of policyholders and the integrity of the insurance market. Professionals should approach such situations by first identifying the core economic and risk transfer characteristics of the transaction. They should then consult the relevant sections of the AIRC framework, looking for definitions, principles, and guidance related to reinsurance and risk transfer. If the transaction appears to align with the functional definition of reinsurance, even if it uses novel terminology or structures, the professional should proceed with the assumption that it falls under reinsurance regulatory oversight and seek further clarification or guidance if necessary. This systematic, principle-based approach ensures that regulatory intent is upheld and policyholder interests are protected. Question 15. The analysis reveals that an insurance company is preparing to launch a new type of long-term care insurance policy in a particular U.S. state. The policy features innovative riders and a unique premium structure designed to adapt to evolving healthcare costs. The compliance department is tasked with determining the appropriate product filing method with the state's Department of Insurance. Given the novelty and complexity of the product, which filing system, if incorrectly applied, poses the greatest risk of immediate regulatory noncompliance and potential market withdrawal? Option A. Implementing the product under a use and file system without confirming it is permitted for this product type. Option B. Seeking prior approval for the product filing. Option C. Assuming a file and use system is standard for all new product filings in that state. Option D. Filing the product under a file and use system without confirming it is permitted for this product type. Correct answer is A. Implementing the product under a use and file system without confirming it is permitted for this product type. Explanation. This scenario is professionally challenging because it requires a compliance officer to accurately assess the regulatory requirements for a new insurance product filing in a specific U.S. state, understanding the nuances between different filing systems. Misinterpreting these requirements can lead to significant regulatory penalties, delayed product launches, and reputational damage. The core of the challenge lies in distinguishing between the proactive nature of prior approval, the conditional nature of file and use, and the reactive nature of use and file systems, and applying the correct one based on the specific state's regulations and the product's risk profile. The correct approach involves meticulously identifying the specific state's insurance department regulations governing product filings. This requires consulting the relevant state statutes, administrative codes, and bulletins. For a new, potentially complex product, a prior approval system is often the most prudent and compliant approach, as it ensures regulatory review and acceptance before the product is marketed. This minimizes the risk of non-compliance and subsequent enforcement actions. The regulatory justification stems from the principle of consumer protection, where regulators ensure that policy forms and rates are fair, adequate, and not misleading before they are offered to the public. An incorrect approach would be to assume a file and use system applies without verification. While file and use allows for product implementation upon filing, it still requires the insurer to ensure compliance with all applicable laws and regulations. If the state actually mandates prior approval for this type of product, filing it under a file and use system would be a violation, as it bypasses the required regulatory review. This failure is regulatory because it circumvents the mandated approval process designed to protect consumers. Another incorrect approach is to adopt a use and file system for a product that requires prior approval. The use and file system allows the product to be used immediately upon filing, with the regulator reviewing it afterward. This is typically reserved for less complex or standardized products, where the risk of non-compliance is deemed lower. Implementing a product under use and file when prior approval is mandated is a direct violation of the regulatory framework, as it places a product on the market without the necessary pre-approval, potentially exposing consumers to non-compliant terms or rates. This is a significant ethical and regulatory failure, as it prioritizes speed to market over regulatory compliance and consumer protection. The professional decision-making process should involve a systematic review of the target state's insurance laws and regulations pertaining to product filings. This includes identifying the specific filing system mandated for the type of product being introduced. When in doubt, or for novel or complex products, erring on the side of caution by seeking prior approval is the most responsible course of action. This proactive stance demonstrates a commitment to compliance and consumer welfare, which are paramount in the insurance industry. Question 16. Benchmark analysis indicates that insurance companies are increasingly investing in sophisticated methods to combat fraudulent claims. Considering the regulatory emphasis on proactive fraud detection and prevention, which of the following approaches best aligns with the requirements for an insurer operating under U.S. state insurance regulations? Option A. Implementing a comprehensive data analytics program to identify suspicious patterns and anomalies in claims data, supplemented by a clearly defined set of red flags that trigger further investigation. Option B. Using customer complaints as the sole indicator for initiating fraud investigations, assuming that legitimate claims will not generate such complaints. Option C. Prioritizing the speed of claims settlement above all other considerations, with fraud detection measures being a secondary, reactive component. Option D. Relying primarily on the experience of claims adjusters to manually identify potentially fraudulent claims during the standard claims processing workflow. The correct answer is A. Implementing a comprehensive data analytics program to identify suspicious patterns and anomalies in claims data, supplemented by a clearly defined set of red flags that trigger further investigation. Explanation. This scenario presents a professional challenge because insurance companies are obligated to implement robust fraud detection mechanisms to protect both their policyholders and the integrity of the insurance market. The challenge lies in selecting the most effective and compliant approach from several plausible options, each with potential benefits and drawbacks. A careful judgment is required to ensure that the chosen method aligns with regulatory expectations for fraud prevention and detection, particularly concerning the use of data analytics and red flags. The correct approach involves a multifaceted strategy that integrates advanced data analytics with a defined set of red flags. This approach is best professional practice because it leverages technology to identify patterns and anomalies indicative of fraud that might be missed by manual review, while also incorporating established indicators of potential fraudulent activity. Regulatory frameworks, such as those overseen by state insurance departments in the U.S., mandate that insurers take reasonable steps to prevent and detect fraud. Utilizing data analytics allows for the systematic analysis of vast datasets to uncover suspicious trends, such as unusual claim frequencies, policy modifications, or beneficiary changes, which are often precursors to fraudulent schemes. The incorporation of red flags provides a structured, rule-based layer of detection, flagging specific circumstances or behaviors that have historically been associated with fraud. This combined approach offers a more comprehensive and proactive defense against fraudulent activities, fulfilling the insurer's duty of care and compliance. An approach that relies solely on manual review of claims by experienced adjusters is an incorrect approach. While human expertise is valuable, it is inherently limited in its capacity to process the sheer volume of data and identify subtle, complex patterns that data analytics can detect. This reliance on manual review alone risks missing sophisticated fraud schemes and may not meet the reasonable standard expected by regulators for fraud detection. An approach that focuses exclusively on customer complaints as the primary driver for fraud investigation is also an incorrect approach. While customer complaints can sometimes signal fraudulent activity, they are a reactive measure and do not proactively identify fraud. Many fraudulent activities may not result in a customer complaint, leading to significant undetected losses and regulatory noncompliance. Finally, an approach that prioritizes speed of claims processing above all else, with fraud detection as a secondary, ad hoc consideration, is fundamentally flawed and an incorrect approach. This prioritization directly contradicts the regulatory imperative to prevent and detect fraud. An excessive focus on speed without adequate safeguards can create an environment ripe for exploitation by fraudsters, leading to increased financial losses for the insurer and potentially higher premiums for honest policyholders. Such a strategy would likely be viewed by regulators as a failure to implement adequate internal controls and a disregard for compliance obligations. The professional decision-making process for similar situations should involve a thorough understanding of the applicable regulatory framework, including specific requirements for fraud prevention and detection. Insurers should conduct a risk assessment to identify their most vulnerable areas, and then evaluate various fraud detection techniques based on their effectiveness, efficiency, and compliance with regulations. A balanced approach that combines technological solutions with human oversight and established best practices is generally the most robust and compliant strategy. Regular review and updating of fraud detection systems are also crucial to stay ahead of evolving fraud tactics. Question 17. Risk assessment procedures indicate that a significant number of new accounts are being opened by individuals and entities operating in jurisdictions known for higher levels of financial crime. Given the requirements of the USA Patriot Act, which of the following approaches best addresses the need for enhanced due diligence and suspicious activity reporting for these accounts? Option A. Rely solely on the customer's self-declaration of their business activities and geographic location, without independent verification for all new accounts. Option B. Implement a risk-based enhanced due diligence program that mandates additional verification and ongoing monitoring for customers identified as high risk based on objective criteria, including their geographic location and business activities, and establish clear protocols for suspicious activity reporting. Option C. Bypass enhanced due diligence for any customer identified as high risk if they are deemed a high-revenue client or a strategically important business partner. Option D. Apply the same level of enhanced due diligence to all new accounts to ensure consistent compliance, regardless of the customer's perceived risk profile. The correct answer is B. Implement a risk-based enhanced due diligence program that mandates additional verification and ongoing monitoring for customers identified as high risk based on objective criteria, including their geographic location and business activities, and establish clear protocols for suspicious activity reporting. Explanation. This scenario presents a professionally challenging situation because it requires a compliance officer to balance the need for efficient customer onboarding with the stringent requirements of the USA Patriot Act, specifically regarding enhanced due diligence (ED) for high-risk customers. The challenge lies in identifying the appropriate level of scrutiny without unduly hindering legitimate business operations or creating a false sense of security. Careful judgment is required to interpret the nuances of high risk and to implement EDD measures that are both effective and proportionate. The correct approach involves implementing a risk-based EDD program that mandates additional scrutiny for customers identified as high risk based on objective criteria, such as their geographic location, business type, or transaction patterns. This approach is right because it directly aligns with the principles of the USA Patriot Act, which mandates that financial institutions establish and maintain policies, procedures, and internal controls reasonably designed to identify and report suspicious activity, and to conduct due diligence appropriate to the risk. Specifically, Section 326 of the Patriot Act requires customer identification programs, CIP, that include risk-based procedures for customer due diligence, including enhanced due diligence for customers presenting a higher risk of engaging in illicit activities. This proactive and risk-sensitive methodology ensures that resources are focused where they are most needed, thereby enhancing the effectiveness of anti-money laundering (AML) and counter-terrorist financing (CTF) efforts. An incorrect approach that involves applying the same level of EDD to all customers, regardless of risk, is flawed because it is inefficient and fails to target resources effectively. This approach deviates from the risk-based principles mandated by the Patriot Act, potentially leading to unnecessary operational burdens and a dilution of focus on truly high-risk individuals or entities. Another incorrect approach that involves bypassing EDD for any customer deemed important or high revenue is ethically and regulatorily unacceptable. This approach creates a significant vulnerability by prioritizing financial gain over compliance and security. It directly contravenes the spirit and letter of the Patriot Act, which requires EDD to be applied based on risk, not on the perceived value of the customer. Such a practice could lead to the facilitation of money laundering or terrorist financing, resulting in severe legal penalties, reputational damage, and a breakdown of trust in the financial system. The professional decision-making process for similar situations should involve a thorough understanding of the institution's risk assessment framework, the specific requirements of the USA Patriot Act and its implementing regulations, and the institution's own internal policies and procedures. Compliance officers must be trained to identify red flags and to apply EDD measures consistently and objectively. When faced with a situation where a customer's risk profile necessitates EDD, the decision should be based on the established risk criteria, not on subjective factors or potential business impact. Escalation protocols should be in place to address complex cases or situations where there is uncertainty about the appropriate course of action. The ultimate goal is to maintain a robust compliance program that effectively mitigates risks while supporting legitimate business activities. Question 18. The performance metrics show a significant increase in customer complaints regarding policy terms and conditions, alongside a rise in regulatory inquiries related to sales practices. As the compliance officer, which of the following actions best addresses these indicators while adhering to regulatory expectations for proactive compliance management? Option A. Focus exclusively on resolving individual customer complaints as they arise, without investigating the underlying systemic issues. Option B. Immediately implement stricter sales quotas and performance penalties for all sales personnel to drive better adherence to policy terms. Option C. Rely solely on the findings of the upcoming external audit to identify the root causes and implement corrective actions. Option D. Initiate a comprehensive internal audit focused on sales processes, policy issuance, and agent training, and then review the external audit findings for corroboration and identification of any discrepancies. Correct answer is D. Initiate a comprehensive internal audit focused on sales processes, policy issuance, and agent training, and then review the external audit findings for corroboration and identification of any discrepancies. Explanation. The performance metrics show a consistent trend of increased customer complaints related to policy misrepresentations and a rise in regulatory inquiries concerning sales practices. This scenario is professionally challenging because it signals a potential breakdown in internal controls and compliance oversight, directly impacting the insurer's reputation, financial stability, and legal standing. The compliance officer must exercise careful judgment to identify the root cause and implement effective corrective actions, balancing the need for immediate remediation with long-term systemic improvements. The correct approach involves conducting a comprehensive internal audit specifically focused on sales practices and policy issuance, followed by a review of the external audit's findings to ensure alignment and identify any gaps. This approach is right because it directly addresses the observed performance metrics by initiating a thorough internal investigation into the suspected areas of noncompliance. Regulatory frameworks, such as those governing insurance sales practices and consumer protection, mandate that insurers establish and maintain robust internal controls to prevent and detect violations. An internal audit provides the necessary depth to examine processes, training, and individual conduct, while cross-referencing with external audit findings ensures a holistic view and validates the effectiveness of the insurer's compliance program. This proactive and thorough internal review is a cornerstone of responsible compliance management. An approach that solely relies on the external auditor's report without an independent internal investigation is professionally unacceptable. While external audits provide an objective assessment, they may not have the same level of access or focus on granular operational details as an internal audit. Relying solely on external findings could lead to a superficial understanding of the issues and a failure to identify systemic weaknesses within the organization's day-to-day operations. This neglects the insurer's fundamental responsibility to self-monitor and self-correct. Another incorrect approach is to immediately implement broad, punitive measures against sales staff without a detailed internal investigation. This is ethically problematic as it punishes individuals without due process and fails to address the underlying systemic issues that may be contributing to the problem. It can also damage employee morale and create a climate of fear, hindering open communication about compliance concerns. Furthermore, it bypasses the regulatory expectation of a fair and thorough investigation before disciplinary action. A third incorrect approach is to focus only on addressing the immediate customer complaints without investigating the root cause of the policy misrepresentations. While customer satisfaction is important, this reactive strategy fails to prevent future occurrences. It ignores the potential for ongoing noncompliance and the risk of further regulatory scrutiny. Compliance requires a proactive approach to identify and mitigate risks before they manifest as widespread problems. Professionals should adopt a decision-making framework that prioritizes a systematic, risk-based approach. This involves 1. Acknowledging and analyzing performance indicators that suggest potential compliance issues. 2. Initiating a targeted internal audit to investigate the suspected areas thoroughly. 3. Collaborating with external auditors to ensure comprehensive coverage and validation. 4. Developing and implementing corrective action plans based on audit findings, focusing on both immediate remediation and systemic improvements. 5. Establishing ongoing monitoring and testing to ensure the effectiveness of implemented controls. Question 19. Governance review demonstrates that the board of directors of an insurance company consistently approves management's strategic proposals with minimal independent deliberation, often citing management's deep operational knowledge as sufficient justification. The board is now considering a significant new product launch recommended by management, which carries substantial underwriting and market risks. What is the most appropriate course of action for the board to ensure robust governance and compliance with regulatory expectations? Option A. The board should form a special committee comprised of independent directors to conduct a thorough, independent assessment of the product's risks, financial projections, and strategic alignment before making a decision. Option B. The board should defer the decision until management can provide further assurances that the risks are fully mitigated, without actively seeking independent validation of these assurances. Option C. The board should approve the product launch based on management's expertise, as they are best positioned to understand the operational intricacies and market dynamics. Option D. The board should delegate the final decision-making authority for the product launch to the chief executive officer, given their ultimate responsibility for the company's performance. The correct answer is C. The board should approve the product launch based on management's expertise, as they are best positioned to understand the operational intricacies and market dynamics. Explanation. This scenario presents a common governance challenge, where a board must balance the need for independent oversight with the practical realities of management's operational expertise and influence. The professional challenge lies in ensuring that the board's decision-making processes remain objective and are not unduly swayed by management's perspectives, particularly when those perspectives might align with short-term gains or personal interests over long-term solvency and policyholder protection, which are paramount in insurance regulation. The correct approach involves the board actively seeking and valuing diverse perspectives, including those from independent directors and external advisors, to challenge management's assumptions and recommendations. This ensures that decisions are robust, well-considered, and aligned with the insurer's fiduciary duties to policyholders and its long-term financial health. Regulatory frameworks, such as those governing insurance companies, emphasize the board's ultimate responsibility for oversight and strategic direction, requiring them to act in the best interests of the company and its stakeholders. This includes a duty to question, scrutinize, and if necessary, reject management proposals that do not meet these standards. An incorrect approach would be to defer entirely to management's recommendations without independent verification or critical assessment. This failure to exercise due diligence and independent judgment constitutes a breach of the board's fiduciary duties and regulatory obligations, can lead to decisions that prioritize management's convenience or short-term benefits over the insurer's long-term solvency and policyholder security, potentially exposing the company to regulatory sanctions and reputational damage. Another incorrect approach is to allow a dominant personality or faction on the board to stifle dissenting opinions or critical questioning. This undermines the principle of collective responsibility and can lead to groupthink, where potentially flawed decisions are made without adequate debate or consideration of alternatives. This also violates the spirit of independent board oversight mandated by regulators. Professionals should approach such situations by first understanding the specific regulatory expectations for board oversight and director responsibilities within the insurance sector. They should then foster an environment where open discussion and constructive challenge are encouraged. This involves ensuring that board members have access to sufficient, timely, and accurate information, and that they are empowered to seek clarification and engage external expertise when necessary. The decision-making process should involve a thorough review of management proposals, consideration of potential risks and benefits from multiple perspectives, and a clear articulation of the rationale behind the board's final decisions, particularly when they deviate from management's initial recommendations. Question 20. Consider a scenario where an insurer's actuarial department proposes a new rate-making methodology for a specific line of business. The proposed methodology, while projected to improve the insurer's profitability, is based on a new set of risk factors that disproportionately increase premiums for a particular demographic group. A consumer advocacy group raises concerns that this methodology may lead to unfairly discriminatory pricing. The Associate Insurance Regulatory Compliance AIRC. What is the most appropriate course of action? Option A. Advise the actuarial department to adjust the methodology slightly to appease the consumer advocacy group without fundamentally altering the core profitability drivers of the proposed rate-making approach. Option B. Dismiss the consumer advocacy group's concerns as purely subjective and proceed with the implementation of the new rate-making methodology, as the primary responsibility is to the insurer's financial health. Option C. Recommend the immediate implementation of the new rate-making methodology, trusting the actuarial department's expertise in ensuring actuarial soundness and profitability. Option D. Conduct a thorough review of the proposed rate-making methodology, focusing on the justification for the new risk factors and their impact on different policyholder groups to ensure compliance with regulations against unfair discrimination. The correct answer is C. Recommend the immediate implementation of the new rate-making methodology, trusting the actuarial department's expertise in ensuring actuarial soundness and profitability. Explanation. This scenario is professionally challenging because it requires the compliance officer to balance the insurer's financial interests with the regulatory mandate to ensure fair and equitable rate-making. The core tension lies in the potential for a proposed rate-making methodology to disproportionately impact certain policyholder groups, even if it appears financially sound from the insurer's perspective. Careful judgment is required to identify and address potential discriminatory outcomes that could violate regulatory principles. The correct approach involves a thorough review of the proposed rate-making methodology to ensure it adheres to the principle of actuarially sound rates, which, under the specified regulatory framework, implies rates that are not excessive, inadequate, or unfairly discriminatory. This means scrutinizing the data used, the assumptions made, and the resulting rate differentials to confirm they are directly related to the risk being insured and do not create arbitrary or unjustifiable distinctions between policyholders. Regulatory guidance emphasizes that while insurers must remain solvent, this cannot come at the expense of fairness to consumers. The compliance officer's role is to act as a gatekeeper, ensuring that the insurer's pursuit of profitability does not lead to regulatory noncompliance. An incorrect approach would be to accept the proposed rate-making methodology solely based on the actuary's assertion of its financial viability and actuarial soundness, without independent verification of its fairness. This fails to address the regulatory requirement to prevent unfair discrimination. Another incorrect approach would be to dismiss the concerns raised by the consumer advocacy group without a detailed investigation into the specific allegations of disparate impact. This demonstrates a lack of due diligence and a disregard for the potential for regulatory violations. Finally, an approach that prioritizes the insurer's immediate financial gains over potential long-term regulatory repercussions and consumer harm is fundamentally flawed and ethically unsound. Professionals should employ a decision-making framework that begins with a clear understanding of the relevant regulatory requirements, particularly those pertaining to rate-making and unfair discrimination. This involves proactively seeking information, engaging with relevant stakeholders, including internal actuarial teams and external consumer groups, and conducting a comprehensive risk assessment. When faced with conflicting interests, the primary consideration must always be adherence to the law and ethical principles. If there is any doubt about the fairness or compliance of a proposed methodology, further investigation, consultation with legal counsel, or seeking clarification from the regulator is warranted before implementation.